Welcome to another episode of Equity Mates. Great to be back in the studio for another week here. It is Monday and plenty going on in the markets. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Happy Monday.
Thank you. Same to you.
Yeah, victory Monday for you after the Bombers had a historic win yesterday.
Yeah, great win against the Doggies.
Yeah,
kept us in finals contention.
Yes. So Bryce is happy. He's up and about, and expect a lot of energy from that side of the room today.
Huge energy. I'm gonna be all over it this week.
Nice. Well, it's about time. So look, there's a lot going on in markets. Earnings season is obviously kicking off in a big way this week. A lot of companies over the next few weeks letting us know how FY21 went. A lot of interesting stuff to come out there, especially the impact of COVID on a number of industries. But we're not going to talk about that today.
No, we're not.
There's enough going on about the about reporting season on AusBiz and on other financial media channels. We want to talk about another thing that comes out around this time of year, and that is investor letters.
Yes. Before we jump into that though, speaking of reporting season, check out today's episode on Equity Mates Investing Podcast, where we actually listened to some of the CEOs from the big tech companies and tuned in on their earnings call, which is another great resource for investors, retail investors. So anyway, I derailed that. And yes, the other thing that comes out this time of year, Ren, is investor letters.
Nice. And so last week we featured letters from 3 Australian investors.
Yep.
John Hempton, the short seller, Lake House Capital, and Michael Frazis and Frazis Capital.
Yes.
This week we're going overseas. We're going over to the United States. 2 of the biggest names in investing globally. Howard Marks.
Yes, Oaktree. Heard of him?
Yeah.
Yes, Oaktree.
Michael Mauboussin.
Yes, yes. Consilient Research at Morgan Stanley.
So yeah, we're going to talk about, they've both released letters or memos over the last few weeks, and we're going to talk about what was in them, what we can learn from them, and any advice they had around positioning our portfolios for this time. So let's start by introducing them. You gave Michael Mauboussin a bit of an introduction, so why don't you close it out, take it away. Who are these 2 people?
So Howard Marks, as you said, one of the most well-known investors around globally, and we actually spoke about one of his investor letters last quarter from memory, where he was speaking to his son, or about his son.
Yeah, he was working with his son.
Working with his son, yeah. It wasn't about his son, yeah. So he's obviously billionaire investor and co-founder of Oaktree Capital. And they have about 135 billion under management. Yeah. And he is very well known for his memos.
Yeah,
if there's anyone other than Warren Buffett known for their memos, it's old mate.
What's his name?
Howard Marks.
There we go. Yeah, Warren Buffett was once quoted as saying, when I see a Howard Marks memo arrive in the mail, that's the first thing I'll always read. Very quaint, old Warren getting it via mail.
Yes.
We could just get it online. And then Michael Mauboussin is the head of Consilient Research at Morgan Stanley, former head of global strategies at Credit Suisse, former professor at Columbia Business School, written a number of investing books, another big name. So that's who we're talking about today. Let's start with Howard Marks.
Yeah.
His memo was titled Thinking About Macro, and that caught my eye because Howard Marks hates macro forecasts.
Yeah. He is he hates them, doesn't employ any economists at Oaktree, doesn't base any investment decisions, so he says, on macro forecasts, thinks they're a waste of time, and that, they don't really ever pan out the way that they should. Yep. So yeah, you're right. When he's sending out letters titled "Thinking Macro," it's alarm bells.
Yeah, and the first 2 pages of this memo really double down on the skepticism around macro. He in some of the quotes, the macro future isn't knowable. He writes that macro forecasts are likely to turn out to be either A, unhelpful consensus expectations, or B, non-consensus forecasts that are rarely right. And he also suggests that in areas entailing great uncertainty, agnosticism is probably wiser than self-delusion. So he doesn't pull any punches when he's talking about the perils of macro forecasts. But then he does spend the next 15 pages talking about macro forecasts.
But I think in fairness, like, you've always got to continue learning and changing your views and challenging yourself. And I think if you were to unnecessarily stick to a view for the sake of holding that view, then that's where you can come unstuck. So it's good to see that someone for so long has been anti-macro. Now he's talking about macro.
Yeah, but I don't think that's because he's decided that you can all of a sudden predict the macroeconomic future.
No, it's probably more because of the importance it's having on markets.
Well, you've hit the nail on the head. It's almost as if you've read the memo. But yeah, for Marx, the reason that he's written this memo and the reason that trying to predict the macro future is important now is because the market has decided that it's important now. Less and less the market's movement is being driven by the fortunes of individual companies and bottom-up analysis, but rather the market is moving based on expectations around Federal Reserve policy, interest rate movements, quantitative easing, all of these big, in the inflation conversation, all of these big macro conversations that are happening. And so for Howard Marks, it's important because the market's decided it's important.
So how's he playing this then? Like, what's his, he spent 15 pages talking about it, but is it changing the way that he's actually going to be investing at all?
Yeah, so he doubles down throughout the memo on the fact that the macro future isn't knowable. And like a lot of this conversation is centered around the inflation debate that's happening over in the US. And he makes the point that even the Fed have basically come out and said it's uncertain. Jerome Powell had some quote that indicated that, and at the same time, the head of the St. Louis Fed came out and basically said it explicitly that they don't know where inflation's going.
Yeah.
But I guess Marx concludes by talking about how he thinks investors should position their portfolio. And I guess it can be encapsulated as like a proceed with caution approach.
Which was what his last letter was about. Yeah. Essentially that, proceed with caution.
Yeah. I imagine if you went back through the years, a lot of investor letters would end with proceed with caution.
Buyer beware.
Here's what I might do, but proceed with caution.
Yeah.
But yeah, so I think, he mentions some of the ways that you can position your portfolio for this, I guess, uncertain macro future. And he talks about putting a higher allocation towards things like floating rate debt, businesses that can pass on cost increases, and those that can grow profits faster than inflation. But he doesn't see a situation where we should be blowing up our whole portfolio to sort of prepare for this potential inflation.
Yeah, that's what I'm getting at the moment, is a lot of experts channeling that way, but very much with we're going to have a small portion of our portfolio to have the what if we're wrong approach, but the general consensus I'm feeling at the moment is that it's transitionary and we don't have to, as you said, blow up a portfolio.
Yeah. I mean, the base effect of a weak 2020 and the supply bottlenecks easing, that's sort of what we're seeing a lot pointed to for this. More so in America, more so than in Australia, there are some serious indicators that inflation is coming though, like the red hot labour market and a bunch of other things. It'll be interesting to see. Yeah.
Fascinating. And so for those watching at home, where's the best way to actually find these letters?
Same place as we said on Thursday. Reddit has a subreddit where they're all collected. Security analysis is the subreddit. We pulled both of these letters from that subreddit. So let's jump onto the second one because we are running out of time.
Yes.
This one is titled "Everything is a DCF."
Well, if you're an investor who hates numbers, you're going to hate this letter. Yeah. So for those at home who have never heard of DCF, it's a discounted cash flow, and it's a tool that is used to essentially come up with a valuation for a company. Now, there are plenty of ways in which you can value an investment, and DCF for a long time has been, I think when I started investing, I always thought you needed to know how to do DCFs.
You do.
And yeah, but I feel it's no longer as important as many other metrics out there.
Yeah,
or
well,
as used.
Well, so you agree with the trend at the time. I agree with Michael Mauboussin. So we'll see how it plays out.
Okay.
But I think the point of this letter is basically trying to reassert the fact that DCFs are important. That you calculate the future cash flows of an asset, or in this case, a company, and then you discount it back to the present day to come up with a value. That's been the number one tool in an investor's toolkit for generations, and it's gone out of favour. So Mauboussin writes about a recent survey of 2,000 professional money managers or analysts. 88% of them used price to earnings multiples as their number one valuation technique, which surprises me. We all know the perils of price to earnings multiples. And market multiples in general. So enterprise value to EBIT, enterprise value to EBITDA, price to earnings, all of those, most popular way of valuing a company.
It's because it's easy.
Yeah.
No, I think, and I'm sure it says it in here as well, each time we speak to investors on the show about using DCFs, it really just comes down to assumptions.
Well, this is the thing, and Mauboussin makes this point in the letter, that DCFs are hard.
Yeah.
And they're hard not because they're technically hard, but they're hard because you need to get the right numbers
A lot of
in
research,
it.
yeah.
You know, small tweaks to growth rate, to discount rate, to assumptions about future profitability, to cost base, all of that stuff will massively change the intrinsic value or the number you get at the end.
Yeah.
But just because they're hard doesn't mean they're not important.
Of course.
Yeah.
I think, if we'll often talk on the show about plugging into, a DCF calculator on the internet or whatever, and I think that's not a good example of the effort that is actually involved in creating a good DCF.
No, because the hard work is in accurately forecasting.
Absolutely.
Yeah.
And actually understanding all the drivers that are going to impact the numbers that go in.
Yeah.
Yeah.
But yeah, this letter was a good one, I think, just reasserting why they're important. It had this quote, which I like. Public stock exchanges are wondrous. When you buy a stock, you trade cash for a portion of the future cash flows of a business. When you sell a stock, you trade the cash flows for cash. It's a form of time travel.
Nice.
Didn't mind that.
That's good. That's good. So, he is obviously still using the DCF. If you think about how you invest, where do you lie on that?
Yeah, I still use it. But the thing for me is that the work in modelling companies' futures is where I am weak, and I think a lot of people are weak. And partly it's because I don't do enough work, and partly it's because I don't have enough information to do it well. But the end result of it is it's assumptions based on assumptions that we can't test properly and stuff like that. But it's a skill that I think is worth learning and doing. What about you? You would be
I'm in the 88% who say that price to earnings multiples. No, I think you're right. For me, at this stage, plugging it into a calculator online is almost pointless in terms of as you've said, you've got to put in much more work in actually giving thought to the numbers that are going into it.
Yeah. For me, the reverse DCF is a good one as well, where you, rather than putting in all the numbers and getting an intrinsic value or a valuation at the end of it, you use the share price as the value, and then it spits out what the market's expected growth rate is based on, or the required growth rate to meet that valuation.
Yeah, that I think puts it in perspective more when you're talking about what is required to get to this, and you'd be like, that doesn't feel right.
Yeah. The other challenge that modern investors face with DCFs is so many of these businesses are unprofitable. And have the balance sheets to be unprofitable for a long time.
That's a good point.
And so if you're trying to value the present value of future cash flow, but that cash flow isn't expected to materialize until year 4 and onwards, that becomes a very difficult exercise in modelling.
Good point.
Yeah.
Well, that brings us to the end of today's episode, Ren. So as a reminder, plenty of value in these investor letters.
Yeah, we should also plug that both of these letters were included in our Thought Starters email that went out this morning. So if you want to keep up to date with these letters, with other interesting content that we're reading, head over to our website and sign up to the email.
Yeah. Otherwise, another big week coming up this week. Reporting season continues. We've got experts for Watchlist Wednesday. So stick around and we'll see you tomorrow.